Hey everyone, Daniel Snyder here from Seeking Alpha. Thank you so much for joining us today. And thank you for being patient with us. We're dealing with a little bit of tech here stuff on our side. But now that we've got Steve Cress pumping in here live from downtown in New York on the island, we are excited to dive into the top 10 stocks 2025 recap today with all of you and how Steve came about these picks. And we're kind of teeing this up because here in January, we'll do it all again for next year. But first things first, let's go ahead and get your investing disclaimer out of the way here for me. So we are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, strategy, or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents my opinions and Stephen Cress's opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results, and Seeking Alpha is not a licensed security, dealer, broker, U.S. investment advisor, or investment bank. And now with that out of the way, Steve, it is great to have you joining us here today. I love specifically this webinar that we get to do every year, which we've now been doing for the past few years, right? We've been doing top stocks since I believe 2022. And every year I get to see these 10 picks from the beginning of the year to the end of the year. And I gotta give you your applause, right?
Thank
I
you
mean,
so much.
well done this year. This has been tremendous. I can't wait to go through all the names. And I know everybody here joining us as well is looking forward to getting into it. But for the people that are joining us today who may not know who you are, the quant savant, would you mind giving us a little bit of background?
Oh, Daya, thank you for that warm welcome and that praise. I truly appreciate it, as well as you organizing this webinar. And happy to share a little bit about my background. I've been in the world of finance for over 35 years, and a good portion of that has been focused as a quant. The bulk of my career was spent at Morgan Stanley, where I ran a proprietary trading desk in quantitative strategies. I also worked at Northern Trust as the head of international in the asset management division. And I also founded a quant hedge fund and a fintech company. And that quant fintech company was actually purchased by Seeking Alpha, and that is what has brought me here today. So we've just been able to unveil some great products, and our users have found that a very enriching experiencing using the tools and resources that we've put available. And as part of it, I use the tools and resources as well. And that's what enables me every year to have this top 10 list in the beginning of the year. And since 2022, we have been knocking the cover off the ball with our picks. And part of what we're going to do is not only showcase the picks that we had for last year, but tell you a little bit about how we will be picking the stocks in January of 2026. So I'll take us on to our next slide. And this is just sort of our agenda for the presentation today. Why quant? Looking at 2025, the market recap, and looking ahead a little bit and reviewing our top stocks for 2025. So if you're not familiar with quant, I'll give you a little bit of insight into how we believe it works. I actually come from the vantage point where my quant system really reflects what a fundamental analyst does that would work at Morgan Stanley or Merrill Lynch or Wells Fargo. And that's pretty much where I sharpen my teeth. I started in the industry as an investment analyst, and much of what I do on the quant side really reflects what I did as an analyst. So for the most part, when I refer to analysts, they look at stocks from a fundamental perspective. And we actually include many of the investment characteristics and styles in what we do and what analysts do on a daily basis. So the element of quant that we sort of add on top of that fundamental analysis is we say quant uses math and algorithms to identify investment opportunities. And every quant has a different style. Our style is what I refer to as a GARP style, where we focus on companies that have growth at a reasonable price. And then there's the plus strategy, because we also look at momentum and analyst EPS revisions. But that GARP strategy, that covers what a lot of analysts do. And we look at stocks that are collectively strong on value, profitability, growth, and as I mentioned, momentum and analyst revisions. So the advantage that you have from a quant perspective is computer processing. So as an analyst, you might be able to cover 15 to 20 stocks in your universe, write about those stocks every couple weeks, and you really don't have like the capacity to handle more than 15 to 20 stocks. The beauty of computer processing is we could look at close to 5,000 stocks, and we will refresh our recommendation every single day. So an analyst might be able to refresh their recommendation on a stock maybe once a month, especially if they're covering about 15 stocks. Because of our computer processing, we look at cash flows, income statements, balance sheets, and hundreds of financial metrics, and we run it through our computer system every single morning at 4 a.m. And by 6 o'clock, we have refreshed our quant scores that enable us to have a fresh recommendation on every stock every day. So that's really the beauty of it. And when we do it, we're looking at each company relative to its sector. So it's really important to understand when you value a company, you have to value it on the conventional value metrics, but you have to look at it from a growth perspective, a profitability perspective, but you're not looking at just in its absolute terms. You have to look at where it lies versus its peer group. And that's exactly what we do. And that enables us to rank stocks from 1 to 5,000. And within each sector and industry, we can sift the strong companies from the weak companies. And we have a pretty good track record at it. So here is our 5-year track record. This is actually not a back test. This is the simulated trades that have occurred since we launched the quant system. And what you're looking at is a rebalancing on a daily basis of our strong buys. And you can see that the quant system on the left-hand side, our performance from that daily rebalance over the last 5 years is up 228%. By comparison, if you look at Wall Street strong buys, it's up only 32% over the 5-year period. And if you looked at the S&P 500 on an equal weighted basis, that's up about 65%. So our quant system, by using that GARP approach and looking for the companies that rank the strongest, the performance is there. So that's the 5-year history. On the next chart, let's just make it a little bit more relevant. You can see year to date, our quant strong buys are up about 30% versus Wall Street analysts up 21%. And this is actually a pretty good year for Wall Street analysts. And the S&P 500 on an equal weighted basis is up about 11.7%. I think if you looked at the S&P on a market cap weighted basis, it's probably closer to 16 or 17%. But Quant definitely well ahead of the pack year to date and over the last 5 years. So let's give a little bit of a market recap and looking ahead. It has actually been a fairly volatile year. It's kind of interesting because we're still close to market highs for the S&P 500 and the NASDAQ, but market sentiment has been all over the place during 2025. And you could see by looking at the CNN Fear and Greed Index on the right-hand side that it has had some pretty sharp movements going from extreme greed to extreme fear to fear. It has literally been all over the place. And that volatility, without question, it impacts investors and the decisions that they make. So what are some of the catalysts that have moved the fear and greed index this year? Well, we saw, especially early in the year, rapidly changes in the trade policy, particularly between the US and China. And that led to a major sell-off in the beginning of the year, which was recouped as some of the trade negotiations proceeded. But early on, people didn't really know what was going to happen. And markets are very, very fearful anytime that there's tariffs. We've also had conflicting labor data, which ultimately really led to the rate cuts. And there was some recession speculation that was driving the market and some of that sentiment as well. We had a credit downgrade, and we also had the longest US government shutdown. We also had a period where tech valuations and the AI bubble concerns really impacted the market. And that was just a couple of weeks ago. So there's been a lot of catalysts to impact that fear and greed, which basically results in a fluctuation or oscillation between sentiment and investing on fundamentals. And when you get into that sort of fear aspect, people tend to sell companies that have good fundamentals. They go into cash, they go into consumer staples, they go for the safe haven stocks. And we've seen that fluctuation a couple times this year. So this is a good table here. And actually, Daniel, you and I were talking about this earlier. I'll let you just highlight this.
Yeah, so as you've been talking about, sentiment's kind of been all over the place this year in 2025, and it kind of is reflected here within the different sectors and across the metals and other commodities and currency indexes, if you will, as well. So let's break this down. So obviously, you've seen certain sectors this year, such as technology and communication services, saying, "Hey, it's risk on." Cryptocurrency, right? Bitcoin for the longest time, saying risk on in the market. But then you also had the traditional safe havens of gold and silver and the like also taking off incredibly high, with a massive returns this year, which no one kind of had on their bingo card at the beginning of January, if you remember. So why is that? Well, there's a lot of this rotation that we've been seeing going on within 2025 of people kind of pulling away from the US dollar. I just pulled up DXY, the US dollar index here on Seeking Alpha, and it shows me year to date it's showing that the index is down about 9.5%. So that move away from the US dollar strength, also the move away from Treasury. So if you go to the next slide here, I pulled this. This actually just came out this morning across my desk is the China's international reserves. And you're kind of seeing them just load up on the gold bullion. And they're kind of doing that as potentially their safe haven trade. But the rest of the world is still fueled by this AI and risk on sentiment. And that's where you're kind of getting this clash of, well, which one is it? And we don't really know. So it's an interesting time that 2025 has panned out like this. And it'll be interesting to see in 2026 if the metals continue the run that they've had.
Yeah, and I'll just actually going back to the previous slide. Let me click up there. Um, you can see on the U.S. equity sectors year to date, technology is up 27%. But just along the lines of what you were mentioning, if you look at the 1 month return and you go to the bottom, you can see consumer staples is up 2.3% versus like a year to date where it's down 0.5%. You can see that healthcare is up 3.3%. That's typically a safe haven sector as well. So as we're coming towards the tail end of 2025, the market is still concerned, and that's sort of setting the groundwork for going into 2026. Um, so let's take a look at the year a little bit more closely, and then we're going to get into a review of the stocks. So here on this chart on the right-hand side, this actually is much more than the year. You can see the rate of tariffs going all the way back to 1920, when we had Smoot-Hawley, when we had reciprocal tariff acts, and then you could see in 2025 the Trump trade war with a complete surge there, straight up going through the roof. And this, saga and turbulence obviously impacting the market. Early in the year, this Liberation Day that we had drove a sharp spike in volatility and a huge sell-off in April with the S&P 500 selling off. We've had escalating U.S. trade disputes, particularly, as I said, between the U.S. and China, which dragged the EV and battery makers and semiconductor manufacturers all into the picture. So tremendous volatility with many of those sectors. There was a truce that did occur between the US and China in mid-May. And at that point, that gave the market a good foundation to rally to those highs that we saw in October. So May through October was a really good period. Going to take us to the next chart. And the reason why I want to point out this chart is there was a lot of volatility. In fact, when we got to that part initially in the year where the trade wars were at a peak, the S&P 500 had actually pulled back 15% at its max. And the reason why I like that number, and we did a little bit of a back test to look at the last 5 pullbacks that the market had. And there was a little bit of a panic that just started to occur at that point. And when you see panic, you see markets that are driven by sentiment, and you see a flight to safe haven sectors, to cash, to gold, which the gold aspect we've continued to see throughout the year, but it does present opportunities. And nobody's completely sure where the year ahead is going to go. As I had shown you on the US sector chart over the last 4 weeks, we've actually seen consumer staples and healthcare be quite strong, again, defensive sectors. But what I will highlight is if we do see the market pull back, what I love about this, when we assess the last 5 pullbacks to 15%, we found that if you bought the S&P 500 at that 15% pullback, and the market over these last 5 pullbacks could have been more than 15%, could have been 20, 25, 30, 35%. But if you use the 15% pullback as a decision-making point to buy the market, if you bought the S&P 500 and you held it for 2 years, you were up almost 50%. So again, that's on average for the last five pullbacks of 15%. If you bought the S&P 500 and you held it 2 years, you were up almost 50%. Conversely, if you bought the top 10 quant strong buy stocks at that 15% pullback, you would be up 117%. And I included a couple of quotes here that you can see on the left-hand side. One from our contributor at Seeking Alpha, Colin Roche, said the stock market is the only market where things go on sale and all customers run out the door. And then Peter Lynch, one of the most famous investors of all time, said the key to making money in stocks is not to get scared out of them. So super important. And that's exactly what happens. When we go into these corrective phases, people sell stocks that have good fundamentals. And that's what we do. We recommend stocks with good fundamentals. And you'll often during these pullbacks, so the market's down 15%, you could see our stocks pull back 20, 25, 30%. But hence, when sentiment fades away and people return to fundamentals, that's why there's such huge upside in the 2 years following that. And Warren Buffett saying, be fearful when others get greedy, and greedy when others are fearful. And my own saying is, fear fades, the market will always return to fundamentals. So if we do hit a period where we get into 2026 and we're going to be recommending the top 10 stocks for 2026 on January 6th, if the market fades at some point, just say, hey, this could be a good opportunity to purchase more of these stocks that have excellent fundamentals. So that's really the point that I'm trying to make here. And we are seeing some murky economic data. And we have seen the Fed take rates down 3 times in the second half of the year, indicating that there are some issues with the labor market. So the conflicting economic data that we see in May, we saw Moody's downgrade U.S. credit. Everybody was pretty familiar with that. And that was probably one of the lowest points in the market. That was actually a really good opportunity to sort of buy into the market. Major brokerage firms have cut their recession odds following the tariff truce. So that's been good. We have seen worsening labor data, and that solidified the case for interest rate cuts in September, October, and most likely even in December as well. Inflation has been a little bit on the stickier side. So that's what has caused concern that the Fed may not lower rates, but they did feel uncertain enough about the labor situation that they wanted to take rates down. So we have a nice chart on the right-hand side here that shows the quits rates continue to trend down, and that is for employment, and that comes from Indeed.
Yeah.
So
That dual mandate thing, right, Steve? So
yeah,
the Fed's looking at the inflation side, but they're also looking at the employment side. And obviously, yesterday we just had the other 25 basis point cut. And they're talking about there's a little weird thing going on in the employment market right now, on top of inflation also still being sticky. So it's kind of like, where do they go from here? They just want to wait and see.
absolutely, that's spot on, Daniel. Spot on. And here, Daniel, maybe you could tell them a little bit about the
Yeah, I'd be
plot.
happy to. So
Yeah,
dot plot comes out every time, no matter how much the board of governors may not like it. They have to put their dots on this plot. So what are we looking at here? Well, we're looking at updated dot plots over time from the meetings. And you're seeing more recently that as these are projected out into the future, they're calculating in less and less cuts, which can obviously be a little weird in an economy that needs to stimulate certain sectors like housing or consumer discretionary, for example. So that's why people are looking at this right now and refinancing debt, and obviously watching the debt levels of the United States government and the economy going on here. So it looks like interest rates are projected to stay kind of around these levels right here, unless there's a black swan event, of course. But companies, management, they're all going to have to factor in that this might be the new reality, and they're going to have to take their companies in whatever direction they need to do to hopefully continue to grow EPS and revenue for people.
well said. Thank you. And the AI premium, how much of it is priced into the market? So no question about it. Our mega cap stocks and the Magnificent Seven are almost for the most part perceived as AI players. and their valuations are quite extended. So market valuations are centered on the Mag 7, which trades at 31 times forward earnings versus just 22 times earnings for the S&P 493. Now, of course, people refer to the S&P 500, but if you take out the seven stocks, it would be 493 stocks. So that is a huge difference, a multiple of 31 times versus a multiple of 22 times. And the S&P 500 is very top heavy, with 35% of the total market cap attributable to the Mag 7 stocks. And a lot of that CapEx growth is coming from the Mag 7 stocks. And that does work its way out to some of the suppliers and the smaller companies. Hyperscalers are committing enormous CapEx, as you can see on the chart on the right-hand side. It is absolutely going through the roof in terms of their CapEx spend now versus what it was a decade ago. And a lot of that, again, just focused on making AI scalable for them and trying to develop new products that will give them incredible market share. What are we seeing in terms of where they are now? Well, NVIDIA's strong Q3 led to a tech sell-off. I think a lot of people thought that was already baked in. So how much good news, as we show here, was already through the price. And US equities slipped today, actually, as Oracle had mixed earnings. And again, that stoked fears about tech valuation. But again, I'll bring us back to that first bullet point. If you looked at the S&P 493, the multiple for the market is about 22 times. I feel given the anticipated growth for companies coming into 2026, that might be a little bit on the rich side, but it's not extremely rich. Obviously, not nearly as rich as the S&P 500 when you bake in the Mag 7. So let's talk performance.
Victory
We're
lap,
gonna
Steve. Take your victory lap. This is
all
great.
right. I appreciate it. I'm not big on victory laps, but this is our quant system for 2025. And I guess back in January when I picked the top 10 stocks for this year, it has resulted in very good performance. You could see from the date that we did it, which I think was uh,
January 9th, if I remember.
what date was that, Dale?
I believe it was January 9th.
January 9th. All right. So this is from January 9th right through to here. I'm actually,
So yesterday's close.
yeah, December 10th. There we go. Yeah. Fortunately, the little source there was covered up by a navigation bar. So I apologize about that. But excellent returns. Up 45.68% versus the S&P up 17.6%. So we have some good returns. The reason really why I want to share this is if you look at the beginning of the year, you could see the market was very focused on companies with good fundamentals, and our performance basically shot the moon. But then when we got to that time frame around February, where the tariffs really just took over the conversation and the concerns of the market, there was a massive sell-off in these top 10 stocks. So by the time you got to May, the S&P 500 was really outperforming the stocks that we recommended. But I will say this time and again, when we hit a market that is driven by fear and sentiment, companies with good fundamentals will sell off. And this is a perfect textbook case example of what happened. The fundamentals for these companies really did not change. It was just the market perception and fear and people going into gold and cash and consumer staples. And as soon as that the truce really was announced with China, the market started to feel a lot more comfortable. And it was at that point where the market again shifted from sentiment back to fundamentals. And you could see how the stocks with great fundamentals absolutely took off and far, far surpassed the S&P 500. And really, we've seen this repeat itself in 2022, 2023, 2024. We've had great performance each year, but each year we've had some concerns in the market where you could say it was driven more by sentiment than it was fundamentals, and then it rotated back to fundamentals. And that's why we've had some exceptional years. Let's take a look at the next slide. So if for the top 10 stocks going back to 2024, if you bought those stocks and you actually held on to them and you didn't sell them, you would be up 356% versus even the Mag 7, which is up only 103% for the same period, and the S&P 500 up 47.79%. So really incredible performance. And I often tell people, even if a stock is no longer a strong buy or buy, if it's a hold means hold. It doesn't mean sell. So get rid of the stocks where you see the sell. If it's a hold and you still like that stock, you still feel there's potential for growth, and maybe the market valuation is just not completely aligned, but there's still strong growth, you want to hold on to those stocks. And taking a look at our top 10 for 2023, those are up 187% if you held them to this date versus the S&P 500 up 85%. And now we're going to get into our top stocks from 2025, the ones I recommended in January, and I want to provide a little bit of an update on those. You can see the names right here. We have Celestica, and what you can see here are actually the current ratings as well, which is really important. So, as I mentioned, these stocks are up 45% since January 9th. 6 out of the 10 names have generated positive returns. You're rarely ever going to get all 10, not even close to it. You're always going to have a couple that have negative returns. But the key is to have the ones that are the winners outproduce the losers. And typically from the winners, we're aiming to have maybe 3 of those stocks that have moved up significantly. And that's happened every year for us. And 2025 was no exception to the rule. We had some stocks that really did great, very much AI related with Celestica and Credo, both of which are still strong buys. We have Urban Outfitters as a strong buy still. OppFi is a buy. And I remember that stock did really well as soon as we recommended it. And then it completely got crushed when the market rotated away from fundamentals into sentiment. And that has started to come back recently. The others are a hold, and the only one that has dropped down to a sell is Stride. And the growth aspect of Stride is still actually fairly attractive, but the EPS revisions grade, which are analysts who are taking estimates down, and also the momentum grade, those 2 grades have led the stock to be a sell. So let's dig into it a little bit more.
Well, Steve, one second. I want to make sure
Yeah,
we clarify too that when you put out these top 10 stocks at the beginning of the year, this is not a portfolio that rotates names. Like you put your name on the line, you put the quant system on the line, you pick 10 stocks and they stay in the portfolio the entire year. This isn't a rotating thing. So
right.
it speaks volume
So,
that you pick stocks that actually have great fundamentals.
yeah, and that's what it's about. Like I'm just giving you my 10 favorite stocks at the beginning of the year. This list is really meant for, long-term investors. I mean, obviously they can sell out of them as they choose. We don't know the risk profile for each individual, so you have to invest the way that you feel comfortable. Some of these stocks are smaller, some of these are larger, but we basically say this is the list for the year. And at the end of the year, let's see what the performance is. And we have found year in and year out, we are crushing the S&P 500 by focusing on names that are quant strong buys. And again, what is a quant strong buy? It's a stock that is collectively strong on value, growth, profitability, momentum, and EPS revisions. And that's what we look for. So here are the strong buys in the portfolio still. We have Credo Technology, ticker symbol CRDO. Market cap on this company is 28 billion. So this is definitely a large cap. Is the IT sector where it is ranked 6th out of 536 stocks. And just as a refresher, we bought this in the beginning of the year. In the semiconductor industry, it ranks actually 2 out of 67. The return since January 9th, the stock is up 116%. Their focus is high-speed connectivity solutions for their providers. And they had delivered a record Q2 with revenue up 272% due to new AI connectivity pillars. So the stock definitely benefiting on that. If you look at the table on the right-hand side, you could see, despite the stock being up significantly year to date, the valuation grade is still roughly the same. So it's a C minus now. 6 months ago, it was a C. It did get super expensive at one point, so that valuation grade had dropped all the way to an F, but it's much more attractively valued now. And you can actually see the growth grade as an A plus. So the growth is just stellar for this company. Profitability has actually improved dramatically. So the profitability grade is a B now, whereas 6 months ago it was a D. So profits definitely improving for this company. And in terms of the momentum, it continues to be strong. and analyst revisions continue to be strong. And why is it strong? The analysts are forecasting for their long-term growth rate that earnings will grow at 78% over the next 3 to 5 years. And that is a huge premium compared to the sector. They also have a very high return on equity at 23%. And on a PEG basis, it's at a 55% discount to the sector, coming in with a PEG of 0.07. Analysts really like the company. In the last 90 days, we have had, let's see, 10 upward revisions and 0 downward revisions by analysts. So that means analysts keep revising their numbers up and they do not take it down for this stock. Number two for our performers was Celestica. This company's got a market cap of about 40 billion. It ranks number 5 out of 536 in the IT sector. Their industry is electronic manufacturing, where they rank 1 out of 18. So they've been able to maintain their superiority in the ranking from the very beginning of the year to now, almost the end of the year. This stock was up 240% since January 9th. They manufacture complex hardware platforms for hyperscalers. Revenue grew at about 28% year over year, with their earnings per share climbing 52% year over year in the third quarter. Their forward EPS growth rate is 51%. It's huge. And they hold about 552 million in cash from operations. This company as well on a PEG basis is at a huge discount to the sector of 45%. And in the last 90 days, 14 analysts have revised their estimates up and 0 have revised it down. If you look at the table, you can see the valuation grade now is a D+. So it certainly is a little bit more expensive than when it was 6 months ago, but growth is stronger. You can see growth coming in at A- versus B- 6 months ago. Profitability is stronger with a B grade versus C, and both momentum and revisions looking good, pretty much in line. So stellar performance out of Celestica, even though being up 240%, the valuation is still attractive at this point. OppBuy, that stock was just stellar in January. If you look at the chart here from the Quant rating, you can see we recommended it, and the stock completely surged up until February. And then, unfortunately, when there were tariff concerns, recession concerns, this stock got slammed to the point where momentum and analyst revisions at one point led to the stock becoming a sell. But I'm pleased to say that that the company has gotten through that period, and it is actually back in the buy category. It has a market cap of 927 million. In the financial sector, it ranks 85 out of 681. And within the consumer finance industry, it ranks 9 out of 38. They're a specialty finance platform that works with banks to provide credit products to the underserved U.S. consumer. So a little bit on the riskier side. Hence, when there were recession fears back in February, this stock got completely slammed. But the fundamentals really stayed intact. This company has an 84% forward EBIT growth rate. That is huge versus the sector. They have a 22% year-over-year operating cash flow growth rate. They actually hold about 378 million in cash from operations. And the PE at 7 times it's at a 41% discount to the sector. So OppBuy continuing to look strong with a buy recommendation. And fair to say it's really worked through some of the worst parts of those recession fears, and it's starting to come back now. Taking a look at consumer discretionary company Urban Outfitters, ticker symbol URBN, 7 billion market cap, Quant strong buy within the consumer discretionary space. It ranks 7. It ranks 20 out of 494 companies. And have a little bit of a typo. This isn't consumer finance. This is a retailer where it ranks 4 out of 34. What we'll do is actually take us to the platform. So we're going to go to the Pro platform. We're going to put in URBN so we can take a look at it. And you can see that comes up right away. So this is our stock page. And stock is up 2% today. Pleased to say, if we look at it year to date, we could see that the stock has had 2 nice rallies. One in May when the market started feeling comfortable. This actually was not a really great performer early on, where some of our stocks were good performers right out of the gate. This one kind of actually drifted down. But as soon as we got into sort of that April, May timeframe, it found its legs, had a really nice rally. And now we're having sort of the second rally of the year at this point. I'm going to scroll down and you'll see on the right-hand side, I guess this is plastered all over Seeking Alpha today. We are going to be doing our top stocks for 2026 webinar on January 6th. So please do save that date. I'm going to scroll down a little bit. And what I want to show you are some of the factor grades for Urban Outfitters. So despite the stock being up so significantly this year, you can see the valuation is in line. You can see the growth is in line with the sector, profitability better than the sector, and momentum and analyst revisions better than the sector. When we scroll down a little bit more, as I mentioned, it's a consumer discretionary company, not finance. This is a parallel retail. And within parallel retail, it ranks 4 out of 34. I was highlighting there before. But let's actually even take a look at growth. You see the overall grade is C. So we're going to click on it. And you can actually see the conventional metrics are pretty strong. So we're looking, when we come up with this overall grade, we look at all the underlying metrics, and not these metrics are not equally weighted. Some have a higher weight. One of the ones that has a higher weight is the 3 to 5 year CAGR forward looking. That tends to be a highly predictive factor. And here it's sort of in line with the sector. But many of the conventional metrics of revenue growth, EBITDA growth, earnings per share growth, very, very strong for Urban Outfitters. We can see even the forward EPS on a GAAP basis, it's got a 23% growth rate versus the sector at just 6.74. So I really continue to like this stock. So I would definitely encourage people to, look at that strong buy. Even at this point, the name has definitely been panning out. I'm going to go back to the deck.
Yeah, it seems like management's performing quite well over there.
Yeah, yeah. So, you can't let a couple months, especially earlier in the year, the stock really didn't do anything. People were nervous. Was this one going to be a dud? And here it is coming into the tail end of the year being incredibly strong. Now I'm going to go over the holds. And as I said, hold does not mean sell. Hold means hold. And you can see this is a perfect example, Argon, where the stock was a hold a little bit after April, and it continued to trade really, really well. And why was it a hold? Because the valuation grade is an F. So it does mean the stock is expensive. However, valuation is just one aspect to look at. If you look at the company's growth relative to the sector, it's got an A grade. Profitability has an A grade. Momentum and revisions, A plus grades. So there are a lot of investment characteristics that make this stock look attractive, even as a hold. This is in the industrial sector, and it ranks 107 out of 617. And within construction and engineering, it ranks 15 out of 37. This stock, since January 9th, is up 111%. So, certainly I have not been scared out of this stock. And it continues to perform well. This company focuses on engineering and construction for large-scale power and industrial projects, and definitely a benefactor of the huge increase that we see for energy that is largely being driven by the data centers and powering up these chips. So Argon definitely a benefactor of that. Forward revenue growth is at 28%. Forward EPS growth is at 59%. That's a 628% premium to the sector. This company, Argon, which many people don't even know, it has $22 in cash per share. That is huge for a company to have that much cash per share. And in the last 3 months, the stock has done really well, being up 43%. But again, the growth is phenomenal for this company. The profitability is phenomenal for this company as well. Taking us to our next hold, this stock is, I don't want to say a dog because the metrics still look really good in this company. Has moved to a hold from a strong buy. This is PayPal Holdings, ticker symbol PYPL. Big company with a market cap at 57 billion. Looking at compared to the other financial stocks, it is ranked 240, so certainly not high up there. The industry is the transaction and payment processing, where it ranks 5 out of 431. The stock has had a negative return, so not all stocks for the top 10 do well. This one did not. This is down 30%. You do see good ROE growth from the company. ROE is at 24%. ROE growth is at 10%, which is at a 300% premium to the sector. And in the last 90 days, analysts feel the same way I do about the metrics. You've had 38 analysts take their earnings revisions up, and only two have taken it down in the last 90 days. I'm going to go to the platform on PayPal.
Yeah, it gives you that sentiment read that even though the stock's down so bad this year, people haven't given up on it.
Yeah, and I feel like really I haven't given up on it either because I'm going to go to the growth page here.
It's one of those names that's
Uh,
been like a staple forever, right? It's integrated with eBay back in the day and then branched out, and now they're trying to get into the AI chat world as well. It's interesting looking.
yeah, and one of the things I wanted to highlight with the company here is on the earnings per share growth. Year over year growth is at 3.91%. So I think, that is partially responsible for the stock coming down, that earnings per share growth rate for the actuals is a bit softer than was expected. But if you look at the forward estimates, the forward EPS growth estimate is 13.8% versus the sector at 10.6. So that puts it almost at a 30% premium to the sector. On a long-term basis, you're at 12.21 versus the sector at 11.5. And your free cash flow per share, you can see is a B plus, so it's stronger than the sector. So there are a couple metrics that I like here. And if we look at valuation, we could just see that it has a D minus grade overall. And again, the metrics are not equally weighted. Some bring it down. So price to book and dividend yield are factor weights that are a little bit heavier. But if you look at the conventional metrics, the stock is still fairly cheap, especially if you're looking at it on a peg basis, or even if you look at PE gap on a forward basis is 11 times versus the sector at 12.3 times. So still at a discount to the sector. But stock is down 30% year to date, and hopefully it has hit a floor here. Our next stock, Intap, another stock that has not panned out well. This one's down 32%. Market cap is 3.52 billion. It has a quant hold rating within its industry, which is application software, currently ranks 84 out of 177. So this is not all AI companies are equal. This one provides AI powered and cloud-based software that helps professional firms and financial service firms, but definitely some weakness there. And I think as they came through around their quarter, that had something to do with it. However, more recently, analysts are looking at the stock positively. And in the last 90 days, you've had 10 analysts move their earnings estimates up and zero have moved it down. So hopefully the worst is over for the stock. It is still a quant hold. And Brinker, which just has some terrific restaurants in Chile and Manganitos, that it had a stellar year last year. Even this year, at a certain point through July, the performance was fantastic for the stock, but it did really start to sell off. Since January 9th, the stock is only down 2.27%. And I will say, one of the nice things, year in and year out about this top 10 list, even though we have some losers, again, the winners far outstrip the losers. And that's something that's important to consider. That's why we're going with 10 stocks. We want some diversification, and there's diversification usually within industries as well. This dropped to hold on October 2nd due to slowing momentum and weaker than expected guidance from management. The stock really paid the price on that weak guidance. But overall, very strong return on equity for the company, and their long-term growth rate looks great with 14% EPS forward 3 to 5 year CAGR. Taking us to stock number 9. This one definitely panned out. Since January 9th, the stock is up 23%. That is more than the S&P 500 on a market cap weighted basis and an equal cap basis as well. The stock is currently a hold within the restaurant industry. It ranks 30 out of 46. And I'm going to actually take us to the platform as well because I want to showcase. I think we had another typo there. I really apologize. So we're going to go to DXPE just to clarify that.
Now, Steve, maybe we should go ahead and talk about this because this is a unique stock. It had been a sell rating. It just in the last 2 days switched back to a hold rating. So when
Yeah.
people get these top 10 picks for the year, and obviously the next one we're going to talk about as well is still currently a sell rating. When the quant rating hits sell, is that it? Should we take it as that's the exit of the position?
Yeah, that is typically a period where I do exit the stock. But it's really important, I think, to take a look at these underlying metrics. If a stock hits a sell because there's only like one or two analysts that cover it, and the rest of the factors are still really strong, I think you have to just keep in mind if there's only one or two analysts, they're the sort of public face of Wall Street covering the stock. And if you only have two analysts, it's not a lot. But we do say with the quant system that the best way to know when it's a sell is when you see sell. But this did move back pretty quickly, and that's the reality of the market. Markets move every day. Stocks trade thousands of times a day. Each trade is a vote on the valuation of the company and the profitability versus its sector. And you do have to be ready for companies to make moves because data moves every day. So, and I'll highlight what Daniel's talking about. We're actually really super transparent. We have a ratings page, and it shows you what the rating was when. So this stock had dropped down to a sell, and it had been at a buy. So on November 7th, the stock was a buy. Then it went to a hold, and the stock price did start to drop, and then it went to sell. And you can see when it went to sell, the stock was down to $87 from a buy when it was 101, but it was much higher even before that. Stayed a sell for a while. And then the quant system said, hey, you know what? Looking at these numbers, the momentum started to pick back up, and the EPS revision grade, which is D minus and had been F, that previously, before November 7th, had been in A plus territory. But since there's so few analysts that cover the stock, just one or two lowering their earnings estimates will really knock this grade down. So it's something to keep in mind. But thankfully, the company did come back to a hold. So if you didn't sell the stock, I would say continue to hold it. And if you did get out of the stock, it's just one stock that didn't make it out. We had many others that did. Let me go
Steve,
back to
I
the
will, I
slide.
will mention about
Yeah,
this one specifically because I'm just doing data research here as you're talking here on Seeking Alpha. They did announce earnings on November 6th. So when you look at the dates there for the quant rating changes of when it did switch, it kind of looks like maybe somebody heard the earnings call and maybe didn't like what they heard on the call. Maybe they shook out of the position, maybe forced a little hand on the momentum, and then everybody else said, "What are you talking about?" And now it's coming back. So, I mean, things happen
yeah.
like
You had a couple good beats, going back to the fourth quarter of 23 for their bottom line EPS. They did keep hitting the mark all the way up until the third quarter of 2025, where they missed the mark, and that really did have a impact on the stock. Um, so let's take us back to the slideshow. And our final stock, which is a sell, is Stride, ticker symbol LRN. And you could look on the right-hand side of the factor grades and immediately see why the stock does not look attractive on a momentum basis versus the sector, and on an analyst revisions basis versus the sector. Those are two poor grades within an F and a D minus, hence the stock moving to a sell. And the performance it was good earlier in the year, and then it completely sold off. I'll take us to the platform, and you'll be able to see, when the company announced their results, what happened.
yeah.
Uh, and you can see going back to um, the third quarter, March 2025, they missed on top line pretty much well before that. And after that, the company has been hitting their bottom line number, excuse me. But they did miss that bottom line back in Q3 of 2025, and it did really hurt the stock. If we look at the performance,
Steve, if I can mention too, so they announced earnings, and I don't know if everybody knows this. You get free breaking news alerts on Seeking Alpha as well. So if you follow the stock, you would have seen it as well. Earnings got announced,
absolutely.
and it shows here that there were tech rollout issues driving higher withdrawals. Obviously, Wall Street did not want to hear that, and that's why you see that dramatic drop there in the price of the stock that day.
Yeah, really, I feel like the guidance really hurt the stock. But management was trying to be transparent, and yeah, obviously that's what happened. If you look over the last 5 days, the stock is actually up. If you look at the last month, it's down about 2.3%. I think the stock is trying to find its footing. If we click on growth, you'll see the company actually has some really great metrics. Whether you're looking at top line or bottom line growth, gap or diluted, pretty much a really good report card. However, overall it's a C plus. There are a couple metrics that we do not show that are impactful for growth, and that is what's weighing the company down. But for the most part, a lot of the growth metrics look good. If we click on valuation, the conventional metrics look really good and cheap. So again, a couple of those outliers bringing the stock down, particularly prices to sales, having an impact, the overall grade just being a B minus, despite some really good valuation grades for PE and even sales and EV to EBITDA. In terms of the company's growth, you can see it's got a C plus overall, but when you look at the underlying metrics, some really strong underlying metrics. So looking at this stock, it is ranked a sell right now, and that sell was largely due to momentum and revisions. Should those lighten up a little bit and momentum picks back up and analysts start taking the numbers back up a little bit, you could see that rating change. I'm actually going to click on revisions because 6 months ago it was an A plus, so it looked great 6 months ago versus where it is today. And you can see in the last 90 days, no analysts have taken their estimates up on the company, and four have actually taken it down. So there does continue to be a negative trend, hence the sell recommendation. So, Daniel, I think for the most part, that is going to be it for our slideshow. Maybe you want to tell everybody about our upcoming webinar for our top stocks 2026.
Yeah, I would love to. And thank you for taking the time to walk us through the 10 from this year. So, everyone, as you know, we are about to put on our fourth annual Top Stocks event here, January 6th. Join me and Steve Cress in conversation. We're going to go through the marathon. We're going to lay the land, what we're expecting for the year ahead. And Steve is going to give his top 10 stocks. Now, this is open to any subscriber of any product here on Seeking Alpha. So, it doesn't matter if you have premium, if you have Alpha Picks, if you're a part of an investing group leader service, you can join this event and it will be here live on Seeking Alpha. I highly encourage you to block it off in your calendar. Go ahead and register for the event, and we will send you the link to the live stream here at the beginning of January. So I personally hope to see you all there. I look forward to this event every year. And I think the best thing that you can do, even if you're like, well, maybe I want to follow these stocks or create a watch list, that's exactly what I do. After Steve gives his picks every single year, I put it into a portfolio on Seeking Alpha, and that's how I just kind of keep track, because sometimes the stocks go up, they go down, and I like to see if I can time an entry possibly here or there. But everybody, we hope to see you there. Steve, I want to do talk about as well. You have Pro Quant portfolio, you have Alpha
Yep.
Picks. Why don't you give us a little brief rundown of these two products real fast?
Yeah, so absolutely, our premium platform is fantastic for doing a lot of research. I use that to select the top 10 stocks every year. But outside of January, there are many other times to be investing. And in fact, I always tell people you want to be disciplined with your investing. At minimum, you want to be investing every month, ignoring what the market does, whether it's in a correction or if we have a huge rally, just stick to that discipline. And I created a couple of products to help people do that. One is the Pro Quant portfolio, and the other is Alpha Picks, which is a little bit more known. I developed Alpha Picks about 3.5 years ago. So on the right side, you can see Alpha Picks basically provides you with two new ideas every month on the trading date closest to the first and the 15th of the month. As a portfolio builds, sometimes we have sells. So maybe there'll be like 3 trades a month, but pretty much you can depend on having a new idea at least twice a month, and it has done very, very well. There are some differences. Alpha Picks, we are looking basically for U.S. common stocks. We do have a market cap restriction on the stocks we put in the portfolio, which is north of 500 million. And we also invest in stocks that are over $10. So if you feel like you just want a few good ideas every month, Alpha Picks is a great way to get our quant strong buys throughout the year. If you like more ideas, we have the Pro Quant portfolio. Now, this portfolio I keep limited to 30 stocks, but we actually rebalance it on a weekly basis. So with our back test, which went back to 2015, we found on average there would be 2 to 3 trades per week. Again, Alpha picks 2 per month. With Pro Quant portfolio, it's 2 to 3 per week. We actually invest in almost all ADRs and US stocks. We don't have any market cap restriction the same way that Alpha Pix does. So it really allows you to actually have more diversification in that we're looking at micro cap and mid cap stocks along with mid cap and large cap stocks. So we like that diversification. We like the international diversification that we get through ADRs, and we like the sector diversification. And our backtests have shown over a period of time that actually had better returns than Alpha Pix. So what do those returns look like? Well, for Alpha Pix, which is just the 2 ideas a month. Since inception, it's up 277% compared to the S&P up 82%. Year to date, Alpha Pix is up 45%, as you can see on the right-hand side, versus the S&P 500 up 17%. Alpha Pix has had a terrific year. And then if you look over the last 52 weeks in the far left, you'll see Alpha Pix is up 37% versus the S&P up 14%. If we take a look at the Pro Quant portfolio, we actually just started that in June. And you can see just since June, it's up 29% versus the S&P 500 on an equal weighted basis, up only 9.43% since that period in June. So you can see a very good performance there. This one tends to be a little bit more volatile than Alpha Pix. There is a weekly rebalance with it. It does have smaller cap stocks. So when we go into an environment where investors are trading off of sentiment and not fundamentals, we may see weakness in the PQP platform. But over time, as I said, people return to fundamentals, and we've had really good longer term for the concept of within 1 year. We've had fairly good performance. And Daniel, that's the end of my presentation. Do you have any
Yeah.
questions?
No, I just want to add real quick as well. If you are looking for that systematic approach, that's what Alpha Pix and PQP are for, right? The best way I can think about it is if you're going to go throw a nice, piece of ribs or a brisket in the smoker, low and slow it, that's Alpha Pix for you, right? Maybe you don't have a lot of time for investing research, that's your product. If you're something more like you want to go fast, F1 style, that's PQP, looking at that weekly rebalance in those stock trades. So highly encourage everybody. Click the links here. Our team has dropped some links here for you to check out Alpha Pix and PQP here today. If you're watching the replay, those can be found beneath the video as well. And highly encourage you to check those out. Now, Steve, we got to get into some questions here because there
Sure.
have been some really good ones coming in during the presentation today. I wanted to kick off with the first question that when you give out your 10 picks for the year, do you consider that portfolio to be an equal weight portfolio, or are you weighting those positions differently?
I equal with it.
Equal weight. So similar to a
Yeah.
PQP
Yeah.
style, right?
Yeah. So this year I gave out the recommendations, and I think about 2 weeks later I bought the stocks myself after I gave out the recommendations. I just equal weighted everything. So that's the way I go about it.
All
And that's
right.
how our performance is shown as well.
Yes, exactly. So another question that came in was when you give out the top 10 stock picks on January 6th next year, do you ever carry a stock pick over from the previous year?
You certainly may. I mean, especially if a stock is a strong buy or buy, there's no reason to get rid of it. And if it has good fundamentals, even as a hold. So today, when we show the performance, we actually show the performance from 2023 and 2024 if you held those stocks through to today. So I like having diversification. I like having a number of stocks in my portfolio because I believe personally that diversification helps to minimize risk and maximize your returns. And we even have that in our overall strategy, our quant strategy. We're looking for 5 core factors being growth, value, profitability, revisions, and momentum. So I like diversification through sector and through style and through the quantity of names.
All right. We got a question here from Stephen, kind of the trifecta angle, if you will, says, when you go to select stocks for your own portfolio, do you also look at recommendations from Seeking Alpha analysts and Wall Street analysts when factoring everything together?
Um, I don't factor that in. Um,
You're
so
a
Daniel,
quant
do me a
guy,
favor.
Steve. No one can blame
Yeah.
you. You're a quant guy. All right.
Yeah, yeah, unfortunately, there's a phone going off in my background here. I really apologize. Can I just ask you to say the question one more time?
Yeah. So, I mean, obviously you have the quant system, and I can kind of tee it up a little bit for you here. But the question was, we offer the three ratings on symbol pages, right? The Seeking Alpha Analyst aggregate rating, the Wall Street Analyst aggregate rating, and then the quant system rating. So there was a question here that was, do you recommend we only look at the quant rating or also take into
Yeah.
account the Seeking Alpha Analyst and the Wall Street Analyst ratings, which you kind of do with the revisions? So maybe you can just elaborate.
Yeah, so those are three independent ratings. When I select the stocks, I do not look at the other ratings at all. It's really just going off of the quant data. Again, I apologize, I had a phone blasting in the background. So I do not look at those other ratings. They are independent. I will say though, you as a subscriber are free to look at those ratings. And to a certain extent, we do bring Wall Street into our quant system overall because our model is it's backward looking and it is forward looking. And the forward looking aspect, and I'll actually take us to the platform so you can see what I mean there. So if we look at the growth page, you will see we have revenue growth forward, we have EBITDA growth forward, we have EPS forward. And what we're doing is we're taking these consensus estimates from Wall Street and we actually bring these consensus estimates into our model. So we're not creating our own model per stock trying to factor in growth. We're using these professionals and we're taking the consensus of Wall Street into it. So we use that from Wall Street, but we're not looking at the ratings that you would see on the summary page that has no impact on our stock selection.
All right. We had a question come in here. Said, does the top 10 stocks also get added to either Alpha Picks or PQP?
So the top 10 stocks, they possibly could be. So there often could be crossover. You know, when I'm looking at the top stocks, I do sort of cherry pick. I'll look at like the top 50 stocks overall. And from that top 50 stocks, I will cherry pick the top 10. So there's a bit of an active a managed approach to my top 10 selection. It is not purely systematic. There are additional criteria that I'm looking for with growth of companies, valuation of companies. I also like to have a little diversification when I come forward with a top 10. So it's not a pure systematic approach. And very often, many of those stocks may already be in PQP or Alpha Picks, or they potentially could be stocks that will get selected by them as well.
All right. Perfect. Steve, would you take a moment? There was a question here talking about how frequently. So, obviously, you mentioned earlier in the presentation, the quant system updates every single day. But would you take
Yes.
a moment as well to maybe touch on how often the Wall Street analyst rating updates as well as the Seeking Alpha analyst updates?
Um, so when we take a look at, I'm not sure if this is in terms of the overall performance, but I'm going to go back to the very beginning of this presentation where we were showcasing performance, and that's right here. So for the purposes of this page that you see here, we refresh this every single day. So every day we're looking for the quant strong buys and we're looking for the Wall Street strong buys. So from this perspective, to showcase this performance, and again, this isn't really an investable product because we're looking at all the strong buys on the quant system and all the strong buys from Wall Street. It's more or less just to define that our strategy works really well compared to Wall Street and the overall benchmark. So if that question was coming from this performance standpoint, it gets rebalanced every day. Do you think I would answer the question there, Daniel, or do you think the question was a little bit
The
different?
quant, so yeah, let me kind of elaborate a little bit if I
Yeah,
can. So quant system, obviously we update every single day. Wall Street analysts, those kind of updates whenever the analyst decides to put out their new coverage, right? So that's kind of, correct me if I'm wrong, Steve, but whenever
that's
the analyst
right.
decides to say, hey, I'm bumping up my revenue numbers or I'm downgrading my EPS outlook, that's when the data comes into us. And then for Seeking Alpha analysts, depending on how widely covered the stock is, those Seeking Alpha analyst ratings can update kind of on a rolling basis. It'll either take like the last 30 days of publication of coverage or even
Right.
last 90 days of publication of coverage as it kind of goes through there. So hopefully that answers the question that was
Yeah. And really to the point that I made earlier, fundamental analysts, they can cover maybe 15 to 20 stocks at the most. And, they have to publish these long articles. They manually have to like compare the company's metrics compared to other metrics for stocks. So it's a manual process. So it takes a long time. So just
Yes.
to update one of their 20 companies, they can't do it every single day. You're lucky, if they can do it once a month. Where with a quant system, it does have the ability to do that every single day because we refresh the numbers every day. We're pulling, from S&P Global, which is pulling from the SEC. So whenever there's an update on anything that's cash flow related or income statement related or balance sheet related, when it happens in our system. And as the metrics change, when we're looking at, 100 or so different metrics, those change every single day. We update on the system every day. So there's a tremendous advantage to a quant system because every day you're getting that fresh directional recommendation. Where when you look at a professional Wall Street analyst, you're sort of beholden to when they last wrote a report. And it's very common. Like you could pull a report that it's 1 month old or 2 months old. Do you really want to make an investment decision on an article that was written 2 months ago? I mean, that's like going back in the newspaper 2 months ago, pulling out an article on a company and making a decision from an article that was 2 months old. So to me, the quant system is really the only way to get like the fresh real-time data into your directional recommendation.
All right. Thanks for clarifying that a little bit more. I've got two things I want to touch on here real quick before we jump. I know I let us run a little bit long, but that's because we got started late. I'm sure you have things to do today, so I can't keep you too long, Steve. But first, Tom had written in, how do I set up alerts for when a Seeking Alpha analyst writes about a specific stock? Tom, I highly encourage you, go follow that Seeking Alpha analyst. Typically, if you like the Seeking Alpha analyst about one stock, typically you'll find more ideas, but then that'll also alert you as well, push notification and email about when they do write about that stock. And secondly, Steve, this question's to wrap up with you. We had a question here. Is the quant system updated on Saturday morning or does it wait until the next trading day on Monday?
The quant system does update over the weekend.
Okay. All right. Well, let's leave it
So
there.
yeah, it will update over the weekend, but then we run it again Monday. So there is actually data that changes from Friday to Monday, and that data gets incorporated into the system. So data never stops. Let's say that.
Yes, but also we know where there are those weekend warriors that love to do all of their research over the weekend. So, everyone, thank you so much for tuning in today, or if you're watching the replay, thank you for checking this out as well. Highly encourage you go ahead and register for the Top Stocks of 2026 event. If you're having any issues registering for this event, please reach out to us either at events@seekingalpha.com, or you can reach our customer support team subscriptions at seekingalpha.com. And everyone, if you haven't already, check out Alpha Picks, check out Pro Quant Portfolio, see if one of those things might be right for you for a systematic approach. I know I value them because I get very emotional and sometimes my human bias wants to tell me to buy or sell certain things. So it's nice to just leave it up for the computer. But Steve, thank you so much today for the time. Really, really appreciate it. And everyone, we'll see you again here in the next webinar.
Thank you, Daniel. Appreciate it. Thank you. Bye-bye.